From making explosives to delivering explosive returns, Solar Industries India Limited has taken its shareholders on a wild ride, generating a staggering 34,000% return over the past 19 years. Its market cap has soared from just 168 crore rupees in 2006 to 1,38,757 crore rupees today. But with the stock now trading at a steep 114.7 times earnings multiple, the big question on every investor's mind is, can Solar Industries continue to justify this premium, or is the growth story losing steam? Let's find out. Welcome to Bottomline by Groww. I'm Radhika Bajaj. In today's episode, let's analyze Solar Industries. What's driving its growth, what risks lie ahead, and whether the stock still has fuel left in the tank. Let's first take a look at what's helping Solar Industries' growth. Solar Industries is one of the largest domestic manufacturers of cartridge explosives, detonators, detonating cords, and components which find applications in the mining, infrastructure, construction industries, and defense equipment as well. The company is one of India's largest manufacturers and exporters of explosives and initiating systems, with around a 24% market share. So who exactly are the clients fueling Solar Industries' explosive growth? In FY25, Solar Industries India Limited reported consolidated revenue of 7,550 crore rupees. That's up 24% year-on-year, driven by 6 key customer segments. First up is Coal India Limited. A long-standing bulk explosives contract with Coal India Limited contributed 960 crore rupees, or 13% of total revenue, up 3% year-on-year in FY25. Stable coal mining volumes drove steady orders worth 1,853 crore rupees as of FY24. With India's coal demand expected to rise to 1,325 million tons by 2030, this segment offers long-term revenue visibility. Then there is the non-Coal India revenue. This includes non-Coal India public sector and large institutional mining and infrastructure companies such as power utilities, mining agencies, and other government-owned infrastructure clients. This segment delivered 1,118 crore rupees, 15% of total revenue, up 11% year-on-year in FY25. Supported by long-term blasting contracts. Thirdly, there's housing and infrastructure. This segment targets construction, tunneling, and quarrying sectors. This vertical posted 1,158 crore rupees, or about 15% of revenue, growing 4% year-on-year. With overall construction markets set to hit $1.4 trillion by 2025, this will translate to steady demand for Solar Industries. Let's talk about its exports and overseas revenue. A global growth engine spanning 82 plus countries, this segment contributed 2,900 crore rupees, or 38% of revenue, up 18% year-on-year in FY25. It has grown at a 33% CAGR over 5 years. Solar holds 10% of global TNT capacity, strengthening its export position. Then there is defense. Now the company's fastest growing vertical, defense revenue surged 162% year-on-year to 1,355 crore rupees, 18% of its revenue in FY25. As India's first private firm with an integrated defense facility, Solar Industries produces explosives like HMX, RDX, TNT, propellants for Akash or BrahMos missiles, and advanced systems like loitering munitions. CEO Manish Nuwal expects defense to contribute 30 to 35% of revenue in 4 to 5 years, with domestic and export businesses each making up the rest. Backed by this shift, Solar Industries' order book jumped from 5,129 crore rupees in FY24 to 17,000 plus crore rupees in FY25, with 15,200 crore rupees coming from defense alone. Now that we have an understanding of the company's client base and its stability in business, let's explore the key factors that could drive and sustain its performance going forward. Several strong tailwinds are expected to support solar industry's growth, driven by rising government spending and global geopolitical shifts. India's defense budget has surged 176% over the past decade, reaching 6.81 lakh crore rupees in FY26, 13.45% of the union budget, the highest ministerial allocation. This increase supports the government's push for a self-reliant, tech-driven military under the Viksit Bharat vision. This spike in spending, aligned with 2025's year of reforms, has boosted the defense order books. As India's only private warhead manufacturer, Solar Industries plays a critical role in this transformation. In terms of global tailwinds, Solar Industries also benefits from global ammunition shortages and the EU's Rearm Europe initiative, which aims to strengthen regional defense. The EU's defense budget is expected to hit 1,000 billion euros by 2030, with 40% allocated to equipment procurement. Solar has already secured a significant 6,500 crore rupee export order and stands to gain more due to the global TNT shortage, where it holds a strategic advantage. Beyond defense, the global industrial explosives market is projected to hit 10.5 billion US dollars by 2026, growing at 5.8% CAGR during 2021 and 2026. Rising mining, quarrying and infrastructure demand, driven by population growth and urbanization, is expected to fuel steady growth. Now, despite multiple factors favoring the company's future growth, risks remain, warranting investors' caution. Firstly, there are regulatory hurdles. Operating in a tightly regulated sector, Solar Industries requires multiple approvals, from industrial licenses to explosives safety clearances. Ammonium nitrate, comprising about 65% of raw material costs, is itself a regulated explosive under the Ammonium Nitrate Rules 2012. Any delays in clearances or stricter norms could disrupt operations. Secondly, one has to consider raw material price volatility. Prices of ammonium nitrate and other chemicals fluctuate with commodity cycles. A rise in input prices could compress the company's price-cost spread and squeeze EBITDA margins, especially without sufficient pricing power or backward integration. Thirdly, there is the foreign currency risk. With operations across Nigeria, Ghana, Zambia, South Africa, and Turkey, Solar is exposed to currency swings. In FY24, it suffered 168 crore rupees in translation losses and 112 crore rupees from hyperinflation. While local borrowing and USD billing offer some hedging, forex volatility remains a risk. Fourthly, execution risks and scaling challenges remain. The defense business, although fast-growing, depends heavily on long procurement cycles and budget approvals. Moreover, most orders in the defense sector take years to execute, the benefits of which may not materialize in the short term. For instance, of the 15,200 crore rupee defense order book, 6,084 crore rupees from the Pinaka project will be realized over 10 years, translating to around 500 to 600 crore rupees annually and around 120 crore rupees in profits at 20% margins, far below expectations embedded in current valuations. A booming order book on paper isn't a promise of profits. Also, with 2,500 crore rupees in capex planned in FY26, execution risks loom large. Technical issues, supply chain delays, or cost overruns could impact delivery timelines and profitability. Fifth, there is the valuation concern. Trading at 114.7 times earnings, Solar Industries' valuation already prices in high growth expectations. So, any delays in defense orders, execution issues, or macro headwinds could trigger sharp corrections in the stock price. As such, at this level, Solar Industries has little room for missteps. Execution discipline will be key, and even minor disruptions could trigger a sharp sell-off, making timing of entry or exit critical for investors. What's your take on this explosive company with explosive growth? Will it sustain? Leave your thoughts in the comments. And of course, for more such insights, subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.